price activity. There is Mazgaon, similar kind of picture. KPI Green saw a very large move yesterday. That's pulling back a little bit, 1.5% coming up with volumes. That's why we're putting it out there. I think Zen Technologies, we had the company speak with us yesterday. Stock did well. It's down 1.5%, so pulling back a little bit after yesterday's strong move. So that's basically what we have as far as overall markets go. 72 points is what we have on the Nifty, 18,675 at this point in time. Vetri Subramaniam is with us. He's Chief Investment Officer at UTI Asset Management Company. Vetri, good to have you with us here. Thank you very much for your time. Your view has been that maybe some of the valuation excesses have been have worn off. We're not in that zone anymore. But markets have this habit of very quickly. It's not a long drawn out anymore like it used to be, years ago. Corrects very fast and gets out of one zone, gets into another zone very quickly. Where are we now, Vetri, in your opinion? And my question actually is more directed towards mid caps, small caps, which have seen very sharp moves, 20-25% in just 2 months. Go on.
Sure, Prashant. I think you make an interesting point. Without doubt, the cycles are much more sharper in recent times than they have been in the past. And I think it's not just market cycles, it's also economic cycles. They tend to be a lot more abrupt. They tend to, turn direction quite rapidly. But it's all well contained within a range. It's not like volatility is particularly extreme within the markets. You spoke about mid and small caps. Look, again, there could be a 2-month or 3-month period where one segment of the market does particularly better than the other. But again, if I were to just go back to, where I think from a valuation perspective, markets were very rich, which was, all the way back in the fourth quarter of calendar 21, then there's nothing much to distinguish the performance of the Nifty vis-a-vis the Nifty mid-cap index, vis-a-vis the Nifty small-cap index. They're all sort of plus or minus 1 to 3% from October 2021. So, at a different point of time, one segment of the market may have gone faster, one sector of the market may have gone faster or slower, but net-net, the market's made no progress for almost 18 months now. So I wouldn't read too much into those abrupt, turnarounds or cycles.
All right. Well, for now, a lot of stocks in focus. PB Fintech is the one that's surging away, 5% higher on that stock. A lot of these platform companies have come back in a big way, whether it's PB Fintech, PTM, Nykaa, Delivery, etc. Vetri, hi, good morning. These are some themes that have come back, but these are also themes that have caused investors to burn their fingers quite a bit in the last few years. What do you do now? Do you avoid spaces like this entirely, or do you take the plunge?
Well, two ways to look at this. First of all, as you rightly pointed out, this has been a full cycle, right? These stocks listed, in some cases, they went up, 100% from their IPO prices, and then they promptly sort of gave back, 50, 70, 80% of their gains, and maybe they're just trying to find their feet. Just 2 points I'll make about these businesses. Look, these were always very long growth opportunity businesses. And in an environment where, capital was abundant, the cost of capital was low, people were willing to sort of play up for blue sky scenarios. I think 2 things have changed. One is the cost of capital has gone up quite dramatically, but also to the advantage of some of these incumbents who are reasonably well established in these segments in which they operate. Capital is no longer as abundantly available for anybody to burn. So it's a question of who's able to stabilize their business model faster, prevent the cash burn, and suddenly, for the first time in maybe 6-7 years, there is a constraint which has come upon companies that they can no longer expect capital to be abundantly available and postpone profitability way into the future. So I actually do think for some of these companies, the environment has become slightly more favorable. But again, these are very early days. I think the business models are evolving. Sonia, if I were to look at my own experience, right, we've got some small investments in some of these companies. The way we understood the company before they came for the IPO, the sort of context that we understood when they came with the IPO and how their business model is evolving today, it's changed quite dramatically in just 2 years. And therefore, I think as investors, for us, it's a question of just sort of getting to understand them better. But these are not really big, high conviction bets at this point of time in the portfolios for the reasons I mentioned.
Okay, all right. Why don't you just hold on to that thought? MRF has become the first Indian company to hit 1 lakh rupees per share. In the last 1 year or so, the stock is up more than 40%. It's had a good run. I think, Sonia, the only point is, what about dividend? The last couple of dividend payouts have been very, very measly, but it's a 1 lakh rupees share. Last 12 months up close to around 40%. Remember, if you look at it on a longer term, in 5 years, it's up still 40% only. So the majority of the move actually has come in the last 1 year or so.
And this year it also hit a 1 lakh crore market cap. So, there are a lot of milestones coming in for MRF, but there are reasons for it, right? I mean, earnings growth has been very solid for MRF. If you just look at the full year performance, 20% revenue growth is what we've seen. Even in the quarter gone by, I mean, raw material prices have cooled off, demand has picked up. So I guess a lot of tire companies have been doing very well, but MRF, case in point, 1 lakh rupees in terms of the stock price, 1 lakh crore market cap. So in a league of its own, perhaps.
Okay, all right. That's about MRF. But Petri, the space that's really been calling for attention in the recent past is this renewable energy push. We've heard it in the past, but it seems, the government of India is very, very focused on it. Corporate India as well is very, very focused. Would you play this theme? And if you do, how do you play it? Because some of those stocks in there, they're promised in the past. The Suzlons of the world, the Inox of the world. And they actually, if you look at it in the last 5-10 years, they've been big value destructors. Though in the recent past, they've come back to life. So how do you approach it?
Good question, Nigel. I have too much gray hair on me, and as a result of that, I'm always a bit skeptical when somebody paints a picture of the future without any relationship to valuations, without any context of how regulations might evolve, without any context of how technology might evolve, and without reference to how cash flows and return on capital in the business will evolve. So, I'm not a great fan of getting carried away with those cycles, and I've been long enough in the market to see, some of these stories get very long in the tooth and then, painful periods for a long period of time. I think the biggest challenge that I see in the renewable space in India is a lack of indigenously grown technology. Companies are trying to sort of make acquisitions. They're trying to figure out how to jockey and position for it. But I think we're really sort of on the back foot simply because we didn't have the technology at this point of time. I know government has got a whole raft of schemes they're trying to support through the PLI, through other mechanisms to sort of build the ecosystem here. And I think it's critical for India to pull off and sort of be part of this energy transformation that's likely to happen from carbon to renewable. We need to sort of make sure that we are at the forefront of that and we don't create a new import dependency like we had during the carbon era. But, from a stock market investment point of view, I would say, we are happy to sort of be on the sidelines there. There isn't really enough visibility of how companies are placed in terms of technology and how those businesses themselves might evolve in terms of, cash flow and return on capital.
I just want to, this kind of talks to the kind of market we seem to be in. Pull up a company called Urja. I'm highlighting this only because the stock, it's got large volumes. By the way, it's the third largest volume traded stock on the downside right now. It's down 4%. Sometime back, there was this news that Urja is tied up with a company called Tesla. But this is not the Tesla that is the Tesla. This is not Elon Musk's Tesla. This was, this is a company which operates in the US, but not the Tesla, which, of course, is the one that everyone knows of. The stock did see a very sharp run-up over the last couple of days, and today it is coming off a little bit, 4.5% or so, on very large volumes, mind you, as well. It's a penny stock, 12 rupees or so is where that one is. But just, highlighting that because it's coming up with the volumes. Vetri, two, I think, sectors which you have a positive view on. One is pharma and the other is IT services. Both you think are attractively poised from here on?
Yeah, I'd parse that a little bit. I've been wrong about pharma healthcare for a while. It's been a dog even through the last year. But that's an area where incrementally we still think the valuations are supportive. Most of our conversations with companies across a range of businesses suggest that companies are going back to the drawing board in terms of stabilizing the business model rather than sort of, looking to make extravagant growth plans. And that's typically the kind of environment in which you can, get a good margin of safety in terms of purchase and benefit as these companies start to focus on cash flow and ROC. So it's more of a contrarian position in the pharma healthcare space. IT, I would say actually, Prashant, is very different, right? Because this was the sector which was the face of the bull market, in October 21. Valuations had reached a level which, honestly, the last time I'd seen those kind of valuations, I had to sort of go back in my own history, a decade or more, to see those kind of valuations. And I think since then, it started to correct quite brutally in terms of valuations. But I think we are now getting to a point where incrementally, we're a lot more positively inclined than negatively inclined. We continue to think that the IT companies remain India's most globally competitive set of companies. And, this whole wave of spending that's happening in terms of businesses enabling themselves with technology, I think the Indian companies are, the best partners they can have in that journey. So that's an area where we now think the valuation excesses have worked off. May still take some time because, the sort of headwinds are a little bit adverse in terms of growth in their main market, which is the US. But as I said, we'd rather look at dips over here as buying opportunities in what are fundamentally fantastic businesses, which, return the bulk of their capital back to shareholders.
Okay, Vetri, thanks a lot for joining us and speaking to CNBC TV18. Appreciate your thoughts. I just wanted to make one mention, actually, one correction rather, on MRF. So we were talking about how the stock price has hit 1 lakh rupees and, I had mentioned that the market cap is at 1 lakh crores as well. That was incorrect. It's actually about 42,000 crores of market cap that MRF has hit. Also wanted to mention that, the growth in MRF has come on the operational front. If you look at the margin performance, a year ago, MRF used to have just about 9-10% margins. And this year, MRF's margins have gone up all the way to about 14.5%. And that's where the fillip has come in on the operational front for MRF as well. So all tire companies, not just MRF, have really benefited from this improvement in, their margins.
All right. And a 10-bagger, I think, in 10 years. It was around 10,000 rupees around 10 years ago. So good on that. Now struggling to hold on to that 1 lakh rupee mark. But let's focus on another stock. That's Cummins India. That's the next corporate on our radar. Remember, they have said that they aim to grow at 2 times the GDP and increase profitability by 1% on a year-on-year basis. Well, to understand how are things shaping up, we're joined by Mr. Ashwath Ram, the Managing Director at Cummins India. Hi, sir. Good morning. Thanks so much for joining in. Well, let's focus on the CPCB 4 norms. That's going to be coming into effect in the next few days or so. So give us, a couple of aspects. One, how has demand been? What kind of pre-buying have you seen out there on expected lines? And more importantly, what is the price increase you've managed to push through?
So demand has been very robust. Price increases are expected to go up anywhere in the range from 20 to 50%. So with that in mind, we see a lot of pull from the market at this stage, especially in the current quarters, because the transition is supposed to happen on July 1st, after which we will not be able to sell the old product.
Yes.
Demand is pretty robust right now. Typically, when these kind of transitions happen, after the transition happens, with the pre-buy, there is a little bit of a drop-off. And then over the next couple of quarters, demand starts to pick up. So we are still in line with our thoughts on what we think the improvements in pricing will be post the transition.
Okay, all right. Just a quick question on the CPCB, the old engines, as you said, you could still sell them, but you can't manufacture them. You'll be sitting on some inventory. Can you quantify that, the old engines?
Yeah, almost a quarter worth of engines will be in the pipeline between our genset OEMs and the market dealers. So roughly we expect that level of demand to be spread over the next 2 quarters, and gradually the CPCB4 plus engines and products will transition.
Mr. Ram, hi, good morning. You said 20 to 50% price increases. This has already happened, sir?
This will happen post July 1. So it has not yet happened as of now, but post July 1, all the price increases will be announced.
Okay. And this, these take, the cost to manufacture is higher, and hence the price increases, I'm assuming?
The price increases are mainly because of the change in the technology. You're going from completely mechanical engines meeting CPCB2 norms to CPCB4 norms, which are equal to Tier 4 final norms in the United States. So these are very, very stringent norms. So all engines become electronic. They also need to be added with after treatment. So these are entire new subsystems which get added to the product. And that's why the increase in the cost. A similar kind of trend was seen even in the automotive industry, as that industry went from CPCB3 to from BS3 to BS4 and then to BS6.
Do you expect this to have any impact on demand, Mr. Ram? This is a very, very steep price increase.
Yeah, there is always an impact on demand when there is a transition that happens. But over a period of time, we have seen in multiple markets around the world that the products that we sell are required for core infrastructure and for backup and for emergency use. So and they play a very small percentage as part of the overall infrastructure cost. So companies are able to absorb those, and over a period of time, the demand gets back to a normalized kind of demand.
Okay. I want to also understand what's happening a little bit in terms of the growth in the data center business, because you are the leaders in that space currently. Can you tell us what kind of growth are you looking at there, and how will that be factored into your business in terms of a revenue potential?
Demand in data centers continues to be extremely strong. And we expect this not to be a 1 or 2 year trend, but a trend which could last as long as a decade. We think we are well positioned for that, and we have already factored those into our overall growth plans.
Okay. Can you give us some numbers? No, I was just asking, I mean, since demand in data centers is so strong, can you give us some numbers on how this would affect your power generation segment? I mean, even in the year gone by, right? Or rather in the quarter gone by in Q4, you had almost a 43% growth in your power generation segment. You're sitting on a base of about 700 crores. What kind of growth do you see given that demand is so strong?
See, our aspiration from a growth perspective, we have made very clear. We are aspiring to grow at 2x of GDP. There are many, many variables and many market segments that we play in. Data centers is just one of the market segments. So certainly, even if data center were to grow at even better than the numbers I mentioned compared to the GDP, overall, when we look at the business, we still are maintaining that aspiration to keep growing at 2x of the GDP.
All right, Mr. Ram, give us a couple of more aspects then. Exports is 25% of business. In the past year, well, you had a good growth, 27% growth in FY23. For FY24, given the global challenges that everyone's talking about, or which could creep up at some time during the year, what kind of a growth are you guiding on the exports front? Will we see high single digit, mid single digit, or can you guide for double digit? And also a quick word on the supply chain. That was a bit of a hurdle, a headwind for some part of the last year. Are things cleared out on that front now? Things are much better?
Not much better. The same kinds of challenges continue. The challenges with electronic components and the challenges with capacity on certain nodes, they continue. They will continue because it takes 18 to 24 months to set up incremental capacity in some of those spaces. So we expect to continue to have some of those challenges. As far as global demand is concerned, it is mixed in the sense that certain markets let's say Europe, Latin America, and some parts of China have started to recover. Some parts like Africa and Middle East and South Asia are actually slightly muted right now, but it's a wait and watch. We remain cautiously optimistic that we will be able to do better than last year as far as exports is concerned.
So mid-single digit growth. Mid-single digit growth would be fair?
I would say as of now, that would be fair.
All right. Mr. Ram, on margins, I think the stated objective is to have a 100 basis point improvement in margins. This is in FY24.
So this is our aspiration. Like I said, it's straightforward for management to have all kinds of aspirations, and we've been working very hard. Growth in margins for us comes from 3 or 4 areas. One is the introduction of new products. The second is expanding the scope of the kinds of products that we produce. The third is keeping very tight control over all kinds of costs. And fourth is being able to get price leverage in the market. So we are working on all of those areas. Yes, we continue to aspire to want to have a 100 basis point improvement year on year. But as we get closer and closer to the 20% mark, it's becoming more and more challenging. It's never been, achieved and sustained before. So it gets tougher and tougher. But, that's what we are paid to do. And so that's what we're working on.
Okay, well, hope you achieve your target. Just one final question. You have over the last couple of years been undertaking a capex of about 120 to 150 crores. But there are reports suggesting that this year you're looking to do even up to 300 crores. What would the capex plan be for the next 2 years? And how would you be looking to fund this?
Most of it is related to growth and to introduction of new products. And so we are not making any big investments in infrastructure. We already have significant investments there. And most of the growth will be funded through internal accruals. So we are sitting with a pretty strong balance sheet. So we have plenty of cash to make the investments.
All right, Mr. Ram, we'll leave it there. Thank you very much. Good speaking with you, and appreciate you joining us with that outlook. Well, thanks for that. Almost 100 points, 90 points. So slowly but surely, it seems to be. Things seems to be getting better and better. Let's just take a quick look at what else is happening. Maybe the market breadth is, super. 4:1 a market breadth. It's not as if mid caps and small caps have had any trouble recently, and that's not. There's no trouble today as well. If anything, there is a lot of strength, additional strength. HBL Power has been such a large gainer. I think almost 30% last week. It was not there in the morning when we looked at the rates across the board, but 5% on HBL Power, 150 odd rupees. I think this was one of the names on Nimesh's D Street chatter. Some buying at the institutional desk. So stocks are doing well. Cyient is another one which was not there in the mix. It's up about 4% right now. And you got Ujjivan Small Finance Bank, lots of new names. Ujjivan Small Finance Bank, 4.5%. Hudco is up about 3.25%. Linde India is up 3.25%. Dish TV is, of course, 9% higher. It was strong in the morning as well. We've got a discussion on the aviation space coming up. Kapil Kaul, Chief Executive Officer at CAPA, and we'll have the Senior Director at Tristle Market Intelligence and Analytics also joining in to put the focus on that space when we return. A little later after that, we'll have the management of Spandana Sphoorty to discuss their business plans and fundraising. Stay tuned.
Welcome back. It's a really good market. Almost a 100-point gain on the index is what we have on our hands. The Sensex is up 340 points and it's roaring. You know, if you look at individual stocks as well, lot of names, PB Fintech, Tanla Platforms, Cyient, Pidilite, Devyani International, Mankind Pharma, mix of stocks are gaining today and the market is on fire. But let's shift focus to the aviation space now. There's lots happening here as well. With travel back in full form, there's of course prices that are skyrocketing across the country. Go First is filing for insolvency in all probabilities. There's of course grounding of Go First that we've seen, and that will have positive ramifications perhaps for the incumbent players. We have two gentlemen who track this space very closely. Kapil Kaul, CEO and Director at Kappa India, and Jagan Narayanan Padmanabhan, who's the Senior Director at Crystal Market Intelligence and Analytics, who join us now. In fact, Kappa has released a report as well on the outlook for FY24, and in that they have forecasted an industry loss of $1.6 to $1.8 billion. So let's get straight to that. Kapil, thanks a lot for joining in. Very detailed report is what you put out, and I want you to give us just summarize it for us. What is the rationale behind this big loss that the aviation sector will report this year?
Well, good morning. The projections were done in March. At that point of time, the insolvency of Go was not factored in. Our view was that the quarter first of this fiscal, which is what is indicated, airlines like Indigo will have a robust quarter. In fact, they may have the best quarter in their history as for profitability is concerned. But as we go down to Q2 and perhaps Q3, we're expecting a lot of supply, one which is grounded, roughly about 125 aircrafts are grounded. So those aircraft, in majority of those aircrafts will come back. And you would see almost about 100 plus additions that are likely to come for this fiscal. So a combination of grounded aircraft back in the air and a combination of the new capacity that is to be coming most probably from second half of the fiscal. A combination of that, along with the estimates of fuel around 84, fuel around 80 to 82 and the dollar around 85. Those were the projections for the fiscal FY24 when we did these estimates around Feb March. And it's largely because is going to be inducted a lot of capacity based on the trends that we see, and that capacity in a high cost environment would be very challenging to hold up to the yields that you see in quarter one and possibly quarter two.
Okay, let me get Jagan Narayanan Padmanabhan into this discussion as well. Mr. Padmanabhan, Kappa in their report says that there is this large unmet domestic traffic demand, right? Almost 15 million plus in the year gone by. And that's also because more than 100 aircrafts are on ground due to supply chain issues. Do you think this situation could get resolved? Because what's also happening now is this unbelievable surge in prices because of this demand-supply mismatch. What do you see as the way forward in the first half of, or rather in the second half of 2023?
Yeah, so thanks for having me here. And I kind of second what Kapil had kind of mentioned. The realizations that the airlines are having just now is quite unheard of. So that's first part of it in terms of the ticket prices and all of that. But this needs to get moderated, at least in the second part. So there are two aspects to what you had asked. One is the demand part of it, met demand, which is there. The supply part of it. The supply is going to get eased significantly going forward. And also, again, saying what Kapil had mentioned in terms of the new aircraft getting added. So once these aircraft gets added across, then the pricing pressures will start coming in. Then the yields needs to get moderated. Like, for example, Indigo, maybe it's north of 5 rupees that we are looking at 5 rupees per RPK for as an yield. That needs to get moderated going forward. So I think in the shorter term, because of this unforeseen grounding of airlines of Go Air has contributed to this surge in airfare. B, it is also the time when the season for travel for tourism part of it is there, at least on the domestic side, and hence people would have booked some of their tickets and onwards for other parts of it, and they would have had to fly out. So I think those are the things which are contributing at least now. So Q2 may still go at least for the month of April, June and beyond, July first half. afterwards a lot of moderation needs to start kicking in.
Okay. See, from an investor standpoint or the viewers right now, they're interested in a lot of the listed players. So let's talk about that. I mean, there are two of them, right? There's Indigo and SpiceJet. Coupled with Go First's insolvency, it's expected to remove about 9% of the domestic supply in the aviation sector. Now, A, could this result in better yields for Indigo in a capacity-constrained environment? And B, Indigo is already at about 56% market share. Is there scope to grow their market share further?
Well, Indigo is in an excellent position. Even without Go Air's insolvency, Indigo's fundamentals are robust, very strong, a product, brand, cash, almost about 50 more planes coming in, another record order likely. So they have everything is in place with them. So even without the insolvency of Go, I would think Indigo would have been well placed as far profitability is concerned and valuations are concerned. So Indigo is perhaps, as for the sector is concerned, in an excellent position to take forward their strengths and build on from that. As for their let's say profitability is concerned, as I said, I expect a record profitability in Q1, and the market share perhaps depends upon how as and when the Go Air comes back, what will happen to the capacity of SpiceJet going forward, and the kind of capacity that Air India is able to bring in the domestic. But I see their market share closer to 60%, 55-60% for this fiscal. It could touch 60, but 55-60 is a good range for Indigo.
Okay, so record profitability for Indigo this year and market share of almost 60% is what you're looking at by the end of the year.
I said record profitability for Q1. We expect them Q1 to be the best.
Okay, and what about the full year?
Well, as I said, full year we don't share a full year forecast for everyone. We expect that industry would be into losses. Largely, what's going to happen in the second half of the fiscal. But Indigo is well placed to be profitable for this year. This is my assessment.
Mr. Padmanabhan, do you see the Tata Group gain more ground? Because it's, now put together, the Tata Group enjoys about 35% of the air space with Air India, AirAsia and Vistara. Your thoughts on whether they can cede market share from Indigo?
Yeah, so I think it would be good to look at, dissect this a bit more granular in that way, where I think the Tatas would be or planning to focus significantly is in the international market. And they have kind of said that some of the regional routes, they have defocused themselves and want to look at profitable sectors. And also because of the acquisition of Air India in their fold and the slots which are being available and all of that, they would be better utilizing that part of this whole market part of it. And I think they would continue to grow. Their market share will also boost up with Go Air going, taking time to come up. Then that market share will also be gained by Vistara, Air India, and the AirAsia part of it. So all of that is going to go well for the whole Tata Group part of it. So it wouldn't see. I think it won't be a market gain because of Indigo's loss. It will be a market gain, and the overall sector is also expected to grow. I think we kind of talked about, and not seen Tata's report, but our expectation is about close to about 12% growth for FY24 over FY23, and hence that will also aid in overall growth of market. I mean, not market share, but that is the market part.
Sure. Just one final question I have to ask both of you. Of course, we have time only for one, so let me get Kapil into this discussion, into the last point on predatory pricing, right? After Go First's insolvency, and you briefly mentioned that there was suddenly this surge in pricing, but the Civil Aviation Minister a couple of days ago came through and said that, they're not going to encourage predatory pricing by incumbents, etc. But do you think things are going to change over the next couple of weeks? Because there is clearly a demand-supply mismatch at the moment.
Yes, the demand-supply mismatch is very serious. Prior to COVID, if you compare to pre-COVID, we're about 130 aircraft short. We never had such a capacity crisis in the sector that we have been tracking since 2003. So this is quite serious, and the logical outcome of that kind of capacity crisis is that the fares would go up. I am not of the opinion that there should be a knee-jerk reaction as for asking the airlines to reduce fares, whether it's done by the government or the DGCA. There must be an institutional mechanism to check whether competition, consumer, there's an impact on competition, consumer. Unless until we don't have an institutional mechanism, we won't be able to address this. You can address it for a few weeks, 10 days, and then it'll be back to normal. The question is that when you have such a capacity crisis, it is natural for the fares to go up. You have seen ACI come up with a report that India's trajectory in terms of pricing has been highest, but nobody talks that we have 120 plus aircraft on ground. You will actually address this by an institutional framework, by just making and giving instructions or advising the airlines. My assessment that's not feasible. Government needs to set up, and because of the duopoly that we have two large airlines having about 80% of the market share, it is important that the institutional mechanisms in terms of checking competition and consumer impact is addressed, and that has to be done not just during the surge in fare. It's general. Every quarter, stress tests are done whether the consumer and competition impact is addressed. Yes. Otherwise, we'll get this challenge. I don't see how this works otherwise.
Right. Gentlemen, great speaking with both of you. Thank you very much for your time. As always, here on CNBC-TV18, it's a sector which has got everyone's attention, both, of course, because people own stock in companies. There are not very many listed, but, of course, because I guess all of us are flyers. Well, and fares matter. Thanks very much, both of you, for joining us. Now, let's get in the management of Spandana Sphoorty, which is joining us. The board has approved a fundraising of 100 crores via an NCD issue. Shalabh Saxena is Managing Director and Chief Executive Officer at the company. He's joining us right now. Shalabh, good to have you with us here. Just give us a quick sense of this fundraising, what this is about, why is this needed at this stage? And second, about a month ago when we had spoken, you basically had told us that for FY24, you were expecting, about 35-40% kind of growth in assets under management. You were at about 8,500 crores in FY23. Could you tell us how things panned out in the first 2 months of 24? What's the demand for credit on the ground looking like?
Good morning to you and your viewers. First question first. The capital that we are raising, or rather the money that we are raising from the capital market, essentially goes towards the disbursement and the regular growth activities of the company. This year, and I'm just continuing from the last discussion. This year we plan to disburse 12,000 crores, and we'll end with an AUM of roughly about 11,500 crores, because the microfinance loans are typically very short-term loans. So our requirement for funds this year will be closer to about 9,000 crores, and the specific NCD that you've spoken about is a step in that direction. From a mix perspective, typically we used to borrow until last year about 35-38% out of the capital market, and the balance was on the NBFC/bank side, which this year we are planning to take the bank's share and to almost about 75%, so that there's a delta on the cost of funds. There's a advantage that we have on the cost of funds. So this is typically Q1, Q2 in the microfinance industry are a bit muted, and then you scale up as you progress through the quarter. So we are in line with the plan. So that's the first part. The second part in terms of the 2 months. The market and the entire microfinance industry, for that matter, I think is doing good. From a customer point of view, I think the portfolio is holding up both from a demand point of view and, most importantly, the credit quality point of view. We as an institution have seen a marked improvement and a very sharp improvement in the credit quality. I have in this show earlier also mentioned that microfinance is all about risk management. The asset will happen. I think, we are in line with that, the way we are progressing. And I think, we see both very robust and strong demand from the bottom of the pyramid and the rural market that we deal with, which is almost about 90% of our book. And from a credit quality perspective, I think we are very happy and satisfied with the way things are going.
All right. Hi, good morning, Mr. Saxena. And good to hear your positive commentary. AUM, you're expecting to go from 8,500 to around 11,500 crores. And I think from there as well for the following year, you're targeting something around 18,000 crores, I think so, in terms of an AUM move. So we got those numbers. But before we talk more about the operational performance, I want to focus on some shareholding. your erstwhile promoter or the founding member, Ms. Padmaja, there are reports that indicate that she wants to go ahead and sell the stake that she has. And some reports indicated that she wants to raise close to around 100 crores. Have you heard anything? She holds close to around 14% stake in the company. That's currently valued at around 720 crores. So that's a bit of an overhang from a shareholder perspective. Have you heard anything?
So, look, it's a shareholder matter, and we as a management are completely focused in running the company. Having said which, about a year back when we came out with a document, which is a Vision 25 document, which is publicly available, we had run past this entire plan, which was a 3-year plan until FY25, with all the shareholders without any exception. And we as a management have full backing of the board in terms of the delivery of the Vision 25 and the 18,000 crore book by end of FY25 that you just alluded to. So while not appropriate for us to comment on what happens amongst the shareholders or within the shareholder, but as far as the company is concerned, we are completely focused and we have the shareholder backing.
Right, but Mr. Saxena, you mean to say that you have not heard anything about Ms. Padmaja's plans, whether she wants to exit or not? As of now, you cannot comment on that. Is that correct?
Yeah, that's right. I mean, we've read what you've read, what I have read. Beyond that, we stay focused on our.
Okay. There's another PE in there, sir. Kedara Capital. They as well hold close to around 7%. The stock market perspective, they're saying the founding member could possibly look to sell, which you have not heard about. Have you heard about the PE wanting to exit the 7% stake that they have?
I haven't heard about it. And either way, it's a shareholder matter. So I mean, this is a new one. I haven't heard about it.
All right. So is it fair to assume that for now?
Nor are there, to the best.
Sure. Go ahead.
Nor am I aware about any of such plans for the specific name that you quoted. In our view, we have the backing of the board, and that's what we deliver until FY25.
Great.
So it's fair to assume that Ms. Padmaja for now will continue to retain her 14.5% stake in the company, right?
For her to decide once again at the cost of reputation, but it doesn't really disturb the balance of the plan that the company had until FY25.
Okay, just one final question on what the outlook is for FY24. If you can just give us a quick number on what the credit growth could look like.
Yeah, so we're planning a 30-35% AUM growth on the credit quality. We've budgeted a 2% on the credit side, but the way numbers are panning out, I think it will be less for sure. I think we should the numbers we've already presented in we came out with the Vision 25, but I think from a PPOP perspective, I think we should be in the range of about 900 crores, in the range of about 500 crores for the year. So if all goes well, we still have about 3.5 quarters to deliver, 3 quarters and a month. I think from the way the macros are stacked up, the way the distribution is stacked up, I think we are in a good position to deliver.
Shala, thanks very much for your time. Good speaking with you. Good chat as always here on CNBC-TV18. We'll take a break here. Rahul Sharma of JM Financial and Mitesh Thakur will be with us charting trends. So stay tuned. That conversation coming up. Well, time for our special segment, charting trends. Markets looking good, but where do we go from here? What kind of upsides should we project, and what kind of positions should you be trading? Rahul Sharma is Director and Head of Technical and Derivatives at JM Financial Services. Mitesh Thakkar, of course, is with us as well. Gentlemen, good morning. Good to have both of you here. Rahul, let's start with you on Nifty. After what we've done, what's your expectation? Are we really going to break out of this congestion zone and, head substantially higher? What's the view?
Yeah, very good morning. So we have been cooling off after we hit the 18,778 mark, post which, in fact, the consolidation is actually technically very healthy. Now, the key level to watch out for, especially in this week, since we also have the Fed event lined up, with the probability of 72% being paused in a rate hike. So I think 18,700 should be kept an eye on. 18,700 once taken out should call for a new all-time high anytime soon. I think 19,000 is a very reasonable target to have for the current setup. What is crucial as a support is 18,464. As long as we stay above that, the higher high, higher low structure of the market will not be challenged. And we feel that sooner than later, this breakout should take place. Now, a couple of reasons for this. One is obviously the cash-based buying that we've seen, especially from the FIs in the May. We saw a healthy figure from the FIs in cash. It is continuing in this month as well. And secondly, there is no decisive stance taken by any of the institutions in index futures. So you have FIs, DIs, retail, even the prop sides, no decisive shorts being created in the index futures, in spite of the Nifty hitting almost like a new all-time high. So my sense is the market still has room on the upside. Second indicator that we closely track is the market breadth and thrust indicator. So clearly, the health of the market has improved as compared to what we were a few weeks back. And as we've gone up higher, the participation, especially from the mid and small caps, has been pretty comforting. And at the same time, we also believe that it's a good time to take profits in mid and small caps as well. Now, clearly speaking, the mid and small cap indices, the daily RSIs are above 85, 86. It's a good time to take profits because we've seen the kind of rally that we've seen, and a pullback is something that would be ideal for a re-entry. So a couple of sectors which look overrated to us. One is auto. Yeah. Auto has seen the time of its life.
Just 1 minute, Rahul. Reality. Rahul, you've sent us a lot of charts. You've sent us charts on PSU banks, metals, the autos, FMCG. But you mentioned mid-caps. You're saying that you should take profits. So if you can have that mid-cap chart up. So just briefly, very briefly, just talk to us about that. The Nifty mid-cap 100 chart is what you've sent. Yes.
Yes, so, out of all the sectoral indices, auto, reality, mid and small caps, these are the 4 sectoral indices which have performed the best in the last, since 28th of March is where the entire rally began. So in this entire period, mid caps and small caps indices have actually achieved their targets technically. RSIs are very overrated. In fact, if you see long-term charts of these indices, every time the RSIs have gone above 85 and above, it has been a good time to take profits. I think this time also around should not be any different. And from a relative scale, I think it's better to switch money from mid and small caps to some of the other sectors like PSEs, PSUs, as well as metals, which has been a cyclical play. So too hot mid small caps, auto and reality. Sectors which can become hot are the ones which are PSEs, PSUs, as well as metals.
Okay, PSEs, PSUs and metals are what you like. Got that. Mitesh Thakkar is also joining us now. Mitesh, take us through some charts, right, stock-wise. What are the stocks where the charts are looking very bullish, and not just for an intraday trade, but like a positional view?
So, I think my broad call is that the Nifty and the Bank Nifty, both the indices will make a new high, but the outperformance might shift to the mid-cap side. So I have picked up stocks from that sector. A couple of them, when we are looking at very strong breakouts taking place on either the weekly or the monthly charts, supported by rising indicators on the monthly basis. Our indicators will be typically 8, 10, 12-month kind of indicators. And if they get into rising mode, they typically last for about a few months, at least on the lower side, to a couple of quarters on the upper side. So in that sense, I think, all these stocks which I'm covering, I'm looking at a slightly 6 to 9 months kind of a minimum horizon, but maybe, slightly longer time horizon. And I think these stocks will give you 30-40% plus kind of returns. So the first stock on my list is AU Bank. It's broken out of a contracting movement last month. The 690 was the breakout level. The measuring targets of the pattern suggest 960 to about 1000 as the target area on a normal basis. And I think, very clearly 690 was the breakout level, as I mentioned. So 675 becomes your stop loss, and any declines, if there are about 20-30 point kind of a decline, a pullback or a correction, I think there would be welcome opportunities to add on to your long positions. The second stock on my list is Prestige Limited. It was making a rectangular pattern on the monthly chart. It's broken out in this month itself. So while we haven't got a monthly closing, the setup suggests that the breakout is very likely to succeed given the price and volume action, the increase in delivery volume numbers, as well as position of the indicators. Again, here I would look at targets of 690 to about 700 on a normal basis. And 490 was the breakout level. So 480 or thereabouts can be your stop loss. And people can buy now, accumulate on a mild decline to about levels of 525. The third stock on my list is Tata Communication. It made a double top pivot kind of pattern in 2021 at about levels of 1440, and we've just started breaking out of that pattern. The target over here is very aggressive. I think I would look at a target of around 1800 to begin with possibility of 2000 also being tested over here. And a stop loss of 1400 is what I would recommend. And the final stock on my list is Astral Limited. Again, a contracting triangle pattern on the monthly chart. It's broken on the upside. The minimum price targets or measuring targets would be around 2150 to about 2180, with extended targets of possibly 2400 also, a good probability. I think very clearly it's a buy at current levels, accumulate more in case you get mild declines to about levels of 1850, 1875 zones. And I would look at targets of 2150 to begin with possibility of 2400.
All right, thanks a lot for that. Rahul, very quickly before we let you go, anything else that catches your eye in terms of a big upside on the charts?
Yeah, so technically speaking, NBFCs have seen pretty good traction today. Muthoot Finance is one setup which has broken out from its consolidation. We feel there is a quick 8 to 10% kind of a potential from these levels. Apart from that, IT as a sector saw a very good reversal happening yesterday. I think Persistent is one stock that we like at these levels, can easily deliver a target of around 5400, 5450 on the upside. Can be bought the stop loss placed at around 5900. And overall, we feel that, from the auto ancillary space, Bosch is another setup which has seen a good traction happening today. So this stock can also be bought for a new all-time high target of around 20,000. Stop loss can be placed somewhere around the 90,000 mark. And these are some of the names which we feel should outperform going ahead into the next few trading sessions.
All right, gentlemen. Interesting charts and interesting discussion as always. Rahul, thanks for coming on. Mitesh, thanks as always for being here and highlighting those setups. So that's chartically speaking, in terms of how markets are set up. 95 points, still holding. 18,696 is where we are at. We take a quick break here, but on the other side, our special segment, Indianomics. Sanjeev Chadda, the current Managing Director and CEO of Bank of Baroda, ends his term today. Lata will connect with him to discuss details on the transformation which the bank has witnessed under his tenure. Stay tuned for that exclusive conversation.
Today's Indianomics is on the transformation of Bank of Baroda over the past few years from a relatively ignored stock into a darling of even foreign funds. The current MD and CEO Sanjeev Chadha has an enviable record as a bank MD. When he joined Bank of Baroda as MD in the last quarter of FY20, Jan 2020 actually, the stock price was around 90 rupees. Today, as Chadha ends his term, the price is 190 rupees. In FY20, the bank had managed to eke out a profit of just 546 crore rupees. In Chadha's last year, FY23, the profit is 14,110 crore. The gross NPA then in FY20 was 9.4%, FY23 3.79%. Net NPA then was 3.13%, latest year 0.89%. Credit cost then 1.82%, now 0.4%. Sanjeev Chadha took over when the financial merger of Vijaya and Dena banks into BOB had just been completed, but he had to see through the integration of personnel and extract synergies. Chadha was also taking over from P.S. Jayakumar, who was the only instance of a private sector banker to become the MD of a PSU bank. In the 2 terms of Jayakumar and Chadha, Bank of Baroda has been noticed for accelerated digitization of services and for a lot else. To discuss how Bob has transformed in the past few years, I have with me the man himself, Sanjeev Chadha, Managing Director and CEO. Good morning, Mr. Chadha. Thank you very much for joining me. Well, actually, that is the first question. You know, very briefly, what are the 2 or 3 things, or maybe 5 things, that has changed in BOB over the last 5 years?
So I think for any transformation, first there needs to be an opportunity, and then there needs to be an agenda. So I think the opportunity was there because, as you mentioned, Mr. Jayakumar had really come in and brought a lot of change, and initiating change is always tough. The second was that there was a merger which was underway, and it is only times of transformation where then you can really give it momentum. Third, I believe, was COVID, which was a watershed, which had also allowed you to do things which otherwise would have been more difficult.
What did you observe over the 5 years as different?
So I think 4 or 5 things. One was, of course, the fact that coming from SBI, I think the central challenge was how do you make sure that you can get talent? Because if there was one thing which was different, it was SBI, of course, has a great model, homegrown talent, but what could you do in BOB? And I think it was a very pleasant surprise that that Mr. Jayakumar had initiated that change. We were getting people from outside, and as you progressed, you found that it was actually possible to get first-rate talent bank and to retain that. So I think that was the first element of transformation which was there. The second was technology, which was very important. Now, we had made investments in technology, for instance, through a data lake, but ultimately it's important that technology gives you results. It touches the customer. And there, with COVID, there was an opportunity to actually bring about a very wholesale transformation. That's where Bob World came in. Third was, I think, a performance culture, which is very important. And that's something that we were able to build. Now, if you talk to any of our people and ask them about how their branch, how their zone, how their region is doing, people have, again, the important performance metrics, even at 3 o'clock in the night, if you were to give them a call, right? Okay. And the fourth, I think, is important is, again, a governance agenda and a strong sense of ethics. We brought in Dr. Mukund Rajan to help us, again, construct a ethics agenda for the bank, because that is something that really is the bedrock of change that can be sustained. So I think these are 4 or 5 things which were there.
Let me take each of them in detail. One thing you didn't mention, and which other Bank of Baroda old-timers told me, is that you've also introduced, or maybe with Jayakumar, I don't know, a collection mentality. I mean, until very recently, growing the balance sheet used to be the goal, but you gave a lot of stress to collection.
Yeah. So I think it was really identifying that what were the missing pieces, right? And one of the missing pieces was, if you were to look at what is it that, where are we away from the best? One was in terms of growth rate. Public sector banks have been losing market share. The second was in terms of margins, right? They are lower, which are as compared to others. Third was in terms of, again, the asset quality. Right. Part of the asset quality is, of course, cyclical, and we have seen some of the upside from there. But fundamentally, if you want a sustainable transformation, it is the collection mechanism which needs to change. And what we found was, as compared to some of our competing banks in the private sector, the kind of resources that you deploy for collections, again, were suboptimal. And also, again, it was as a discipline not developed. So among the people that we brought in, we also brought in, again, a head of collections from a private sector bank who had been doing it for 20 years, built a large team. And particularly now, as we go into areas like unsecured personal loans, you go in for new-to-bank customers, I think it's very important that a collection machinery actually precedes, again, going aggressively into any business rather than succeeding that.
Okay, no, that's a big culture change. If, you're not just looking at growth, but growth which is sustainable. The other thing that clearly has succeeded, and you alluded to it a couple of times, the ability to integrate lateral recruits. I mean, now even the government is advertising for joint secretary level lateral entrance, but that's a new thing. That it has succeeded so much is a surprise.
So in some ways, you always try to do different things and see what works. So there are businesses which are not native to public sector banks, right? There are disciplines which, again, we have not really developed as well. And the question is, how do you actually acquire those businesses? How do you build those businesses? One way is to get a consultant and help you do it. But what we found was it was a far better idea and something that works far better if you bring in somebody, but somebody at the top. Because it means that you bring in experience. You also bring in the ability to attract a team around that person who's building that business. And that's something that becomes a sustainable business model.
But won't you disturb the salary hierarchy?
So I think the fact is that the third pillar that I mentioned, performance culture, once you build that performance culture where everybody believes that, look, they do need to perform, there is no option, then people actually start coming to you themselves and saying, look, this is a gap that is there in my capability. Why can't we get somebody from outside to fill that capability gap?
Okay. Oh, that's good if lateral recruits have integrated so well. I'll come to these long-standing issues in a bit because the stock market will also want to hear from you the more immediate, performance targets. One, your NIMs. As I said in the beginning, it's a superb improvement. I think it's the best in many years. But is 3.5 or 3.6 maintainable?
So I think there are some structural factors which are at play, which I believe should help us bring about improvement as we go along. There's no doubt that we again at a very fortuitous point in the cycle. But for us, for instance, again, you will find that it is the retail loan growth which has driven growth. So last year, overall growth was something like 17-18% in loans, but the retail growth was 27-28%. And that is something which is significantly margin accretive, in the current context, because corporate loans, again, margins have been under pressure for the last few years. And number two, also, again, because these loans tend to get repriced based upon how the interest rates move. So if we are able to bring the proportion of retail loans progressively up by 2 or 3 percentage points each year, I think this will have a salutary impact on margins as we go along. So that's number one. Within retail loans, the fastest growth has come from unsecured personal loans, which was a new business for us. So last year, the growth was about 100%. And now it has become a significant part of our business. So the book grew from about 10,000 crores to more than 20,000 crores. Now at 20,000 crores, it is about a fifth of what your home loan book is. But because of the margins there, it is almost contributing as much to, again, NII as the home loan book is. So as this grows, and I think we can grow this book to about maybe 4x of its current size before it reaches levels which are with comparable banks, I think that's a big tailwind which is there in terms of margins as we go along.
No, that's where, I worry because Reserve Bank apparently wrote a note to bankers and NBFC heads about unsecured loans and to asking you all to be careful. And, everyone is in retail. And once the interest rate starts rising, do you think that your very good record in bad loans, gross 3.7 or whatever, will that be in danger?
So I think the Reserve Bank of India is right to sound a note of caution, but it also depends where are you in terms of your balance sheet. So there are banks which have got retail loans as 50-60% of the balance sheet. For us, it is about 23-24% of the balance sheet. On the other hand, it is corporate loans which are 43% of the balance sheet. You add international of 17%, it is 60%. So the risk that comes to the bank really is from a disproportionate exposure to corporate. And as we increase the share of retail, the fact is we are de-risking the balance sheet because of the granularity that is there in the portfolio.
Okay. All right. So in your case, it turns out to be an advantage. But time permitting, come back to it. But what about growth? Are you seeing signs of the capex cycle? You did 16% in the just ended year. What do you think could be the goal for when Mr. Chand takes over in FY24?
The fact is you should always trim your sails depending on what is the direction of the wind. So there was a time over 2 years back when corporate growth was not there. So we grew corporate slowly, and that also meant that given the share of corporate, overall growth was also pretty much in line with the market. Last year there was an opportunity which was there because of the macroeconomic conditions. So our stance is that we will try to grow about 2% above whatever the market is, not having a fixed rate of growth, because there's no point pushing at a string, right?
But are you pushing at a string, or are you seeing enough hunger?
I think there is. So it is in what context? If you would take the context of the last year, I would believe there will be a moderation of the growth. If you were to take the context of the last 5 years, I think there's still room for an acceleration.
Okay, so 16 may be tough, but definitely I mean, at least 15, 14 would be possible, you think. Okay, the other point is credit cost. I mean, you have answered about asset quality, but this is an excellent credit cost, 0.4. Is that likely possible in FY24 as well?
So I think two parts to it. One is, to my mind,
or is there even space to go down?
Yeah, on a normalized basis, I would believe we should factor in about a 1% credit cost. That's what normal should be. Where we are today is because of a very positive improvement in the corporate credit cycle in particular, which continued even through the COVID period. I think it is likely to continue. This also gives us an opportunity. At some point in time in this cycle, the ECL norms will come up. To my mind, the fact where credit costs are gives us an opportunity to have overall costs, including ECL, within that 1% standardized figure, which means that the current trajectory that we see in terms of profitability, that should largely be unimpaired, even if ECL were to come in.
Okay. All right. By ECL, Mr. Chadha means expected credit loss, and that is a big issue that bankers are worried about as and when it takes shape, it becomes a rule. We have lots more questions for Mr. Chadha on the digitalization in Bank of Baroda, which has become noteworthy, expected credit loss, how it will impact, and whether a SBI can be replicated in the other public sector banks like they have been able to do in BOB. All those questions after the break. I know for Bazaar, it will be Chartbusters up next, but you will get to hear the entire conversation by end of day. Time for a break. Mr. Chadha referred to ECL, that is expected credit loss, which is
Zee falls in trade after market regulator SEBI bars SL Group chairman Subhash Chandra and Zee and CEO Puneet Goenka from holding key managerial positions at listed entities. These boards says the board is reviewing the order and steps will be taken in the interest of shareholders and the company.
Asian Paints, Berger Paints, Pidilite Industries all surge after crude slips nearly 4% overnight to around $70 a barrel.
Mankind Pharma gains as JP Morgan initiates coverage on the stock with an overweight rating and a target price of 1,700 rupees, citing consistent volume growth outperformance. The brokerage also expects Mankind to continue to gain market share.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always is Mangalam Malu. Well, Mangalam, I think we have our first management who's already with us, so let's get straight to it. Brokerage house... Not yet. All right.
All right, not yet. So we have enough time to speak about the markets though, Nigel. You know, the mid-cap index continues to outperform for the second day running. The good part is that unlike yesterday, the gap up hasn't been sold into. We're holding on with those gains. We're closing in on that 18,700 mark at the high point of trade, and the mid-caps are doing extremely well as well. Remains to be seen whether this sustains in the second half or not, as we're going into, you know, important occasions. One, the US inflation will come by, and secondly, we have the financial services expiry too. But the first hour so far does belong to the bulls. A bunch of news pieces at the bottom of your screen. This one comes in on JSW Ispat, but the sector of the day definitely has been the FMCG pack. Lower crude prices, it's raining around, so maybe demand prospects look good. Maybe as a result of which we are seeing a bunch of these FMCG stocks do extremely well. HUL, ITC, Nestle has hit a fresh record high as well. The FMCG index doing well.
All right, I think it's maybe we could get a couple of investment ideas coming in from our Money Pro, you know, our special segment. Maybe in fact we can get to that, or I'm not sure whether or not we do have the management of Moltech Packaging. Well, we have the management of Moltech Packaging who's with us. Brokerage house Nirmal Bang, they are bullish on the company as well as their prospects. They have a target price of around 1,150 rupees on the stock. Based on the positive commentary coming from